What if I told you there was one single ETF that you could use to become rich without having to spend hours upon hours researching the best companies to buy and having to spend all your free time looking for the next best investment? The ETF that I'm of course talking about is SCHD, or the Schwab US Dividend Equity ETF. It boasts a very impressive annual return, a consistent dividend payout, and it's almost unaffected by the most recent bear run that we've had. The purpose of this video is to help you get more of your spare time back by only having to worry about one single investment that you can hold forever and could even be used to set you up for retirement. This one ETF has even been shown to beat out VOO, or the total stock market index that tracks the 500 biggest publicly traded companies in the US market. While this is deemed normally to be the holy grail of investing, SCHD has actually been shown to beat out VOO not only in share price appreciation but also in dividend payout as well. The purpose of this ETF is to track the performance of the Dow Jones Dividend 100 Index, which is just a collection of 100 of the biggest, most profitable and consistently paying dividend stocks that money can buy. SCHD is made up of 104 different companies, which is relatively small in comparison to other ETFs like VTI, which is almost at 4,000, or VOO, which is at 500. Some of the top 10 holdings include Verizon, Cisco, and Coca-Cola. If we take a look at the performance of SCHD in comparison to VOO, which is just the Vanguard S&P 500 ETF, which is essentially just a representation of the overall stock market, as it includes 500 of the biggest publicly traded companies in America like Coca-Cola, Amazon, Facebook, Microsoft, and all these other big players. So if we take a look at the comparison between VOO and SCHD in the past 6 months, you can see that SCHD, which is the blue line up the top here, and VOO, or the whole stock market essentially, is the orange line at the bottom. So SCHD has consistently been beating out VOO over the past 6 months, and this trend continues over a 1-year time frame as well. And you can see up the top here that since October 21st, 2011, which is when SCHD was essentially made public, it has gone up 329% in comparison to VOO, which is up 316%. SCHD also boasts an impressive dividend of 3.36%. Now that 3.36% dividend payout is split into 4 different payments that are paid out every quarter or every 3 months, in comparison to the dividend that you get with VOO, which is only 1.6%. Over the past 10 years, SCHD has had a historical return of 13.73%. This means if you had invested $10,000 10 years ago, you would have $36,203. Some of the main sectors for this ETF are financials, healthcare, and information technology. It's got a good spread of various different sectors that make up the ETF. This gives you good diversification, so you're not at the mercy of one particular sector and you have exposure to various different types of companies. To show you how effective SCHD can be, I'm going to show you the average returns from it over a 20, 30, and 40 year period, and show you the impact of how contributing varying amounts of money can have a massive difference to the overall value of your portfolio, and how it's even possible to live off the dividend income that you receive from it depending on how much money you're willing to put in. So let's say that you're on a salary of $50,000 and you can put aside 10% of your income. This means you have $416 every single month that you can invest into the stock market. So using a compound interest calculator, I'll be able to demonstrate the growth of your portfolio over all these different time periods. So if you're putting in $416 a month for a 20-year period at that average 10-year return of 13.73%, at the end of it, your portfolio will be worth $440,100 $187. Now, the big thing to look at is that you will only have put in $99,840 and over $340,000 would just be generated from compound interest, which is $14,790 or just over $280 per week, which is definitely a nice chunk of passive income to get. If you continue this for an extra 10 years, meaning you'll have been contributing for 30 years instead of 20, your portfolio will be valued at over $1.68 million. And you only have put in $149,000 of your own money, meaning about $1.5 million generated in compound interest. And you'll get a dividend payout of $56,747 per year, and meaning if you had a salary of $50,000 that you were putting in, you would essentially be getting that back purely just from dividends. And this means every single month you'll receive $1,091 of passive income. And if you push this out a bit longer, over a 40-year period, you'll have $6.2 million. $200,000 of that will be contributed from yourself, so $6 million purely generated from the compound interest of your investment. You'll be getting a annual dividend payout of $208,000, which is $4,000 per week, which is definitely a very substantial amount of money just to get from doing nothing. So let's say you wanted to retire a bit earlier, because waiting 30 or 40 years is a fairly long period of time, and a lot of people might not have that much patience or even that much time left for that. So let's say that you were earning a little bit more money and you were on a salary of $60,000 and you were going to put aside 20% of your income as opposed to 10%. This means every year you would put aside $12,000 or $1,000 every single month. So your contributions would be $230 per week, and if you did this for a 25-year period, you would have $2.09 million as your total portfolio value. $300,000 of that would be your own, and the other 1.79 million would be again purely generated from the compounding effect of your investment. You would get an annual dividend payment of $70,000, and your weekly dividend income would be $1,351. So by increasing your contributions by 10%, in 25 years you would have the same return as you normally would in 30 years. So you'd be making an extra $400,000 with 5 years less total time. Because when you contribute $5,000 per year or 10% of your income on a $50,000 salary, in 30 years you'd have 1.6 million. But if you put in $12,000 per year, then you would have $2 million in 25 years. So you're shaving off about 5 years total, and you'll be making $400,000 extra. So you can see the clear benefit and how much of a difference it'll make if you bump up your contributions. So since 2012, the dividend payout has gone up over 170% from 0.86 cents per share to $2.25 per share. So it's consistently been paying out its dividend and increasing it as well, just like all the companies that are included in the ETF. And over the past year, during the bear run that we've had, SCHD is only down 2% in comparison to VOO, which is down 8%. So even when the market is not doing very well, SCHD still holds strong and its share price doesn't take a hammering. In order for companies to be included in the ETF, they have to have a 10-year history of paying out dividends and increasing them as well. And the vast majority of the companies have a market cap exceeding $500 million. So you're getting a lot of stability and consistency, which is exactly what you need. So even though there are only 104 companies in the ETF, I really don't think that is going to make a massive difference or going to be a setback in terms of whether or not you should invest in SCHD. If we compare the same example across a 25-year period for VOO, with everything being identical in terms of the time frame and the amount of money that's contributed, after the 25 years we would have just over 1.7 million in terms of total portfolio value, which is just under $300,000 less than SCHD, and we'd get an annual dividend of $27,651. So annually we'd be getting $47,000 less in the yearly dividend payments if we were just investing with VOO. So those small percentage differences definitely add up, and the longer the time horizon or the longer the period of time that you are investing, the bigger those small percentages will make. On paper, it might not sound like much if the annual share price or dividend payment is only 1 or 2% different between ETFs, but in the long run, it makes a drastic difference to how much money you're going to get. SCHD also has an expense ratio of 0.06, which is great. I always look for an expense ratio that's well under 0.5, and this means for every $10,000 that you invest, you'll only be paying $6 in fees. While SCHD is a great ETF, it's only one of many that you could be investing in. Check out this video on screen to see some other great dividend yielding ETFs that might even beat out SCHD and could potentially be a much better priority for you to be investing in.